You might have seen ads from our favorite cricketers recently saying mutual fund sahi hai. Invest early, retire early, wo falana dimkana. But if you are not careful enough to do a little bit of research and just blindly invest in what they say, then you might fall into a big financial trap. Recently, a mutual fund house called Quant Mid Cap Fund, which has made more than 74% in a year for their investors, which means it has almost doubled the investors' money in just 1 year. Recently, this mutual fund came into SEBI's investigation. SEBI is the regulator of stock markets in India. Its job is to protect market integrity and investors. In 2024, SEBI launched an investigation on Quant Mutual Fund for front running. If they are proven guilty, then they might have to pay hefty fines and shut down their company altogether. Since the start of the investigation, the investors in the Quant Mutual Fund have pulled out 1400 crore in just 3 days. Fearing the ongoing investigation, the people are feared to put money in Quant Mutual Fund. This is not the first case that happened in the history of mutual funds. Many mutual fund traps and manipulations have taken place over the years. After studying all these cases, the slogan "Mutual Fund Sahi Hai" that does not seem believable and right to me. So how do we not fall into the trap of these mutual funds? I will share some important tips in the end. But before we understand all of this, let's understand how these mutual fund houses manipulate their portfolio profits to attract investors. Number 1. Window dressing. A mutual fund manager might sell off poorly performing stocks in the portfolio right before the quarter ends and replace them with high performing stocks. For example, if a mutual fund initially had a significant holding in a company that has not performed well for most of the quarter, the manager might sell that stock and buy the shares of tech giant that recently surged. This makes the fund's holdings appear stronger in the quarterly report, potentially misleading the investors about the true performance of the fund throughout the period. Number 2. Marking the close. A manager might buy large quantities of stock that they already hold in the final minutes of trading to drive up the closing price. Near the market close, manager places large buy orders for that particular stock. This increased demand will push up the stock's closing prices. As a result of this, mutual fund portfolio's value will appear higher at the end of the day, resulting in a better performance report. Number 3. Front running. Front running occurs when a fund manager uses insider knowledge about upcoming trades to make personal investments before executing clients' orders in their own mutual fund, thereby profiting from the expected market move. This sounds a lot like insider trading, but there is a difference. Insider trading is using non-public private information about a company's upcoming performance, such as earnings call or sales deal that is not yet out in the market, and taking a trade basis on that. But front running is a lot more personal. Based on clients' pending orders, the fund manager places trades in his own account to benefit from the price rise after the pending orders is executed. Well, both are illegal in India, and the fund houses will face hefty fines and they might have to shut down their business because of these activities. The recent investigation of Quant Mutual Fund for front running is not the first case in the history. The first known significant front running case occurred in the United States in 1980s. Ivan Boesky, a prominent stock trader and arbitrager, was accused of insider trading. While Boesky was primarily charged of insider trading, his activities included front running. In 1986, Boesky agreed to pay $100 million fine and serving a jail sentence. The first front running case in India was in 2007. Two mutual fund employees were accused of front running. They used privileged information to trade shares in their personal accounts before executing clients' mutual fund trades. SEBI found them guilty and imposed a penalty, including barring them from accessing security markets. There are many such cases. Even recently in 2021, Axis mutual funds came into light where they were accused of front running. Coming to the ongoing front running case in 2024, the Quant Mutual Fund is under investigation by SEBI for front running activities. SEBI's surveillance system flagged some transactions that might be closely linked with Quant Mutual Fund, suggesting a possible information leak by a dealer or a broking firm that handles its orders. In response, SEBI has conducted search and seize operations in its headquarters in Mumbai and in Hyderabad. Digital devices, including mobile phones and computers, have been seized. Despite these developments, Quant Mutual Fund has assured its investors to fully cooperate with SEBI. Founder and CEO said that the fund is continuing its normal business operations and investment activities, apart from complying with the regulatory inquiries. Though the founder has reassured that they have not done any front-running stuff, the investigation has caused significant market reaction, including a sharp decline in small and mid-cap stocks. Moreover, the fund's clients have withdrawn more than 1400 crores in 3 days. The current laws for front-running in India fall under SEBI prohibition of fraudulent and unfair trade practices relating to securities market regulations 2003. If SEBI proves the Quant Mutual Fund guilty of this front-running charges, then they might be looking at some serious penalty and also cancellation of their license. Now, some of you might think, how is front-running wrong? It is not harming anyone. Essentially, they are not scamming their clients for money. They are just using some information that they know for their own personal gain and personal investments. But here's the thing, all mutual fund managers and brokers have a fiduciary duty, which means they should keep clients' interest over their own personal benefits. Front-running breaches this trust as they keep their own personal benefits over clients' interests. Also, it leads to clients getting worst execution prices because the dealer buys or executes the orders before the client has executed, which can affect their overall investment returns. Also, front-running undermines the principle of fair and transparent markets. It creates an uneven playing field where certain traders have unfair advantages over others. Such practices can erode public's confidence in financial markets. As of recent reports, only 3% of Indians invest in stock markets, whereas in developed markets like US, more than 55% of the population invests in stock markets. Activities like this will further decrease the market participation in India. Also, in cases like front-running, if SEBI decides to shut down these mutual funds, then small retail investors' life savings are gone. Such unfair practices will reduce the public trust. Once the public trust is lost, it is very difficult to build, especially in financial markets. So, is there any way that the investors know beforehand that the mutual fund is going to engage in such illegal activities? Well, short answer is no. But there are few best practices that investor can follow to mitigate these risks. Diversification is one of the most effective strategies to mitigate front running. By spreading investments across various asset classes and different mutual funds, investors can reduce the risk for any single fund's misconduct. Do a bit of your own research. Don't invest just because your friend said so or some influencer said so. Look at the basic public information available. Look at its past performance, not just for the last quarter, but at least for 1 year, and then decide to invest. Do a quick Google search on founders of the mutual fund and read some recent news articles on them to get a holistic view of the mutual fund. So don't be in a bubble that sab kuch sahi hai. It's irony that we work hard for 30 days for a month's salary, but we don't invest at least 30 minutes on stock market investments. So be careful, do your research and invest your money wisely. That's it from me today. I hope you have learned something. I will see you in the next. Until then, bye.